Well, I just move on now, and we are now joined by Nikhil Bhandari, a co-head of APAC Natural Resources and Clean Energy Research at Goldman Sachs. Nikhil, thanks for waiting. Good morning. Appreciate your time here on CNBC-TV18. I'm looking at the title of your report, The Great India Energy Climb. So let me ask you, let me throw it open to you. Just the top 2 or 3 takeaways from the main points that you're making through this report, Nikhil. You tell us.
Yes, absolutely. Thank you guys for having me on the show. Now, look, the main anchor punchline is that we are seeing a structural shift in India's power and the energy demand. We now expect the power demand to grow at over 7% per year through FY35. Now, that's a significantly faster run rate than what we previously expected. The important thing is this isn't just driven by data center, AI, or EV charging, which is the theme of the West for the power demand growth. What's really driving this is the income growth. As more households move up the ladder, they buy more air conditioner, washing machine appliances. So that's driving the growth. The big push towards the manufacturing is driving the industrial power demand growth. So again, we're not upgrading our GDP forecast. We're just upgrading our power consumption intensity to GDP forecast, leading to this punchy power demand forecast number. Now, the other thing that we have done in the report is we have looked at the supply side. Where are the likely bottlenecks in supplying this demand growth? The first one we've talked about is the potential ceiling for the growth in the renewable capacity. After a huge runway of growth in the last 10 years, we have some technical constraints around ramping up renewable at a similar pace for the next 5 to 10 years. So we talk about the bottlenecks there and what's needed to break the bottleneck, which is the battery storage. We also talk about more thermal capacity still needed to avoid a potential energy deficit, which could be as much as 9% by FY35 if we go with just the current pipeline or the current target of the thermal capacity addition of the power system. And the last bit is the bottleneck is the distribution electrification. We've done a great job electrifying our generation, transmission infrastructure, but distribution, the last mile, still needs to be electrified. And our transmission and distribution losses are still high at 18% versus the world average below 10. Now that sets up the investment themes because investors need to own the bottleneck in order to create alpha from a stock market perspective.
So across these 3 themes, Nikhil, talk to us about how to play on the equity side. Just take us through one by one.
Yeah, sure, absolutely. Look, we can't specifically talk about the stocks, but I'll put the framework here. So the opportunity clearly for investors is to own the bottlenecks directly. The first is on the renewable side. The bottleneck on the renewable side is not the solar cell or solar module manufacturing anymore. We're already in overcapacity for modules. In a year or two, we'll be in overcapacity for solar cells as well. Our demand constraint, our demand size is going to be more limited. We are already growing 25 gigs solar per year. We can get to the run rate of 30, 35. But if we keep doing that for another 2 to 3 years, we have a theoretical limit on the coal, because you need a larger base load. And in order to, when your 45% of the capacity mix is solar in your total power capacity, we have to flex down coal during the morning time when sun is shining. And there is a theoretical limits around it. So that defines the demand for me. If demand is growing 30, 35 gigs a year, we have more than enough solar modules and cell capacity coming online. The real bottlenecks here are the polysilicon, the batteries, and somebody who can take polysilicon all the way to create into module and power out of it. We think that is the business model which is eventually going to survive. So that is one. The second is who's going to help us create more thermal power generation, given we have a 7% power demand CAGR, and we have some constraints in the growth in the renewable capacity after reaching this a huge size of 45% in the capacity mix. So thermal generation is another bottleneck. And third is the distribution. It can be played through either the equipment side, because we need to electrify the last mile distribution. We need to put more smart meters, more low and medium voltage distribution lines. And for that, we also need the companies who can work on the ground and electrify the distribution and privatize the discom. So again, those are the main themes that we are focused on from a stock picking perspective.
Yeah, I know. We're regretting the fact that we can't get down to individual stock names or understand that you have limitations, Nikhil. But just talk to us at least about this. I mean, investors could look at an integrated player like NTPC that's doing everything from thermal to renewable to even nuclear they're getting into, or maybe a Tata Power that's looking at both ends of the spectrum. or you could try and target niche stocks and niche companies. For instance, I mean, mentioning offhand, there was this news item on NLC India. They're setting up a battery storage plant now in Tamil Nadu. So what should people look at niche pockets like the solar cell manufacturers or someone who's setting up, a battery storage system? Or are you just best off with integrated players for the next 1-2 years?
Look, our call is really to directly own the bottlenecks. And the bottlenecks, as I mentioned, are who can make the polysilicon, who can make the battery cell, not just the battery packs. Cell is the harder thing to do, not the packs. Packs is a low entry barrier business, but cells is really hard. Who can manufacture the cells? Who can really provide me the equipments for the last mile distribution electrification? And who can build the thermal generation for us? So again, to us, it's more about owning the bottlenecks directly rather than we own every piece of the power value chain. Look, there has been a strong beta in the sector 1 to 2 years ago, and that's because we started seeing power deficit. And when the beta is there, typically the whole sector may do well. But in order to create alpha, we believe we need to own the bottlenecks directly. And these are the bottlenecks that I mentioned.
On thermal, I mean, while your point is well understood that there are certain constraints to ramp up on renewable, but this focus on thermal again, is it a short-term thing? I mean, for next 2-3 quarters? Or is it the next 2-3 years that we're talking, that the focus will remain on thermal and therefore you're looking at, ways of playing that, coal, etc.?
Yeah, look, this is a 5 to 10 year view. Look, there is a discovery of thermal as an important part of India's energy mix still. If our power demand is growing 7% per year and renewable is intermittent in nature, and we don't have a lot of batteries manufacturing locally, I think thermal will still play an important role in the India's overall energy mix and the power mix, because we have to balance both the decarbonization, the environment, but at the same time, the growth that I talked about, the structural rise in the power and energy demand growth in India. We have noticed clearly government did triple out the thermal coal plant addition target about 18 to 24 months ago. And they're looking at about 88 to 90 gigawatt of thermal coal plant addition by FY32. If we assume that comes as per plan with a couple of years of execution, timeline, in addition, we're still seeing about 9%, up to 9% energy deficit in the country by FY35 for certain weeks during FY35. Now, this is not just the non-solar hours evening deficit we are saying, we're talking about the energy deficit. So we need some more reliable round-the-clock solution beyond renewable. Now, what are the options we have? Beyond coal, we've got nuclear. Yes, that'll be an important solution, but nuclear takes longer than coal. So that's a 10-year and onward story, which will be an important part of the mix. But we have a problem heading into the next 5 or 10 years from an energy deficit perspective. We have another option is the gas-fired power plant, but the gas is the most expensive solution on the power cost curve in India. So again, India isn't really at this point building more gas-fired power plants. The third option is hydro. Again, we are going hydro aggressive, which is makes sense, but hydro plants also takes longer than thermal coal. So again, from the reliable round-the-clock solution beyond renewable, the thermal coal still is an important option for the India's power mix in order to meet this 7.2% CAGR in the power demand growth for the next 10 years.
Got that, Nikhil. Good conversation. Thank you very much for joining us, and really provides us with a framework in terms of how to think about the plays around the growth and power demand through various angles. Thanks very much once again. As Nikhil Bhandari of Goldman Sachs with some perspective there.